bringing you Reflecting on 2023, looking ahead to 2024. Before we begin, a few procedural points. At the end of the session, we'll hold a Q&A as time allows. You can ask questions through the Q&A function on the right of your screen. Your questions will only be visible to you and to the Flexport team. We'll share a copy of the slide deck at the end of the presentation. And now, to make the lawyers happy, please keep in mind that all information provided in this session is based on the situation at this current time and may not be customized to your specific business requirements. We always recommend reaching out to a Flexport expert to discuss your particular situation. All right, that out of the way, I am Phil Levy, Chief Economist at Flexport, and continuing a year-end tradition, joining me today is our CEO and founder, Ryan Petersen. Welcome back, Ryan.
Hey, Phil. Hey, everybody. It's awesome to be here.
Okay, well, we got a lot to go through. Our agenda today is actually pretty simple, though. 2023 is drawing to a close. 2024 is almost upon us. We're going to try and identify the big themes that we can draw from the past year and the major things to watch out for in the year to come. I'm going to take the macro situation. Ryan's going to take the logistics. And then we're going to poke at each other if we don't think we make sense. All right, and time permitting, as I said, we will close with your questions. As is our norm, we are going to start with a poll, and you'll find the poll button over on the right. And so we want to hear what you think. We want to hear what your experience was of 2023. So for all of you, was 2023 a return to pre-COVID norms? Finally. Was it a year of adjustment with your main concern being the developments in your industry? Or was it a year of adjustment with the main concern being the big macro questions, like what's going on with interest rates? Or was it just more of we've been going through for the past few years? So let's get some voting going. I see some of you have already jumped in there. Thank you for that. And we have an early lead going to a year of adjustment with the main concern being developments in my industry. Okay, votes are pouring in. Macro's pulling close a little bit. But it looks like certainly a year of adjustment. That the vast majority is there. Does any of that surprise you, Ryan?
Well, just, it depends if you're buying or selling a house and the interest rates. I think otherwise the interest rates are a little too abstract for people to understand how much it's actually impacting them. But it is definitely a factor for everything. This logistics market's been really crazy. So anybody who's importing and exporting goods over the last couple of years is going to be focused on that. So
the part that resonates with me, for all of you who are responding that's industry specific, is we're going to get to some broad economic statistics. But for a lot of these numbers, like what were trade flows, they can look relatively placid at an aggregate level. The moment you dive down and you start separating out, say, and we're not going to do that as much here, but just to note and to reaffirm what our audience is telling us, if you break it down to, say, consumer goods versus industrial supplies versus capital goods, you start seeing things move in a lot of different directions. There's a lot of industry-specific shocks going on.
You didn't mention, Phil, e-commerce, but we're going to talk about that. And the amount of e-commerce parcels is growing like crazy.
That's another good one. All right. Well, thank you, everyone who voted. We very much appreciate it. We're going to jump in, and I'm going to kick things off with setting the macro scene. And what was it that we dealt with in 2023? And as much as possible, I'm going to try to pull out a few themes. If I had to pick a single one, it might be this, and we'll go to the next slide here. The single one would be this battle against inflation. And I've subtitled this, Are We There Yet? Because what you can see in this graph is these are two different depictions of inflation. One is we're almost there yet. The other is, nope, we got a ways to go. And I'll explain what each one is. And I also went far enough back on this that you could see what was the norm that the Fed is trying to get back to. I do this for the US, by the way, but you had the same thing in Europe, where they had the European Central Bank trying to battle inflation. And there's a lot of interesting parallels. There's only so many topics we can cover at once, though, but I'll get to European stuff in a little bit. Here's the thing. What we saw with this, the two numbers you've got, the red line that spikes really high is the consumer price index. And that's the one where we just got some new numbers today. And what I put in was the headline consumer price index. So this was the one I think came in at 3.1% today. This looks like we've largely won the battle that we saw. So the Fed is aiming for 2%. You had a little dip right at the onset of the recession. That's that vertical gray bar. You spike up around 9%, and then you make it most of the way back down to 2%. And so you're at 3.1. Things are looking pretty good. All right. That's actually not the story I would endorse. It's a very popular story. I wouldn't go with that one. I'd go with the other line. I'd go with the blue line. Here's the trick. I'll show you a picture of this in a little bit, but you've got some components of that headline rate which are extraordinarily volatile. The main one is energy. Energy prices have been jumping all over the place. They would, if I put energy prices on the scale, they would just blow out the scale and you wouldn't even be able to tell what was going on with these two lines, which is why I don't, but I'll get to it later. This is why both the Fed and a lot of economists try to look at some kind of core inflation index. And so I've put one here which matches very well with Fed behavior called the trimmed mean personal consumption expenditure, or PCE, inflation rate. So they try to take out the most volatile components. This is something put together by the Dallas Federal Reserve. What you see in this was, well, first, it was kind of slow to get going. It lagged the headline CPI, and you'll note the Fed was a little slow to get going on some of these things as well. It went up, but it didn't go up anywhere near as high. It was more like 5% for its peak. And now it has subsided, but it subsided to closer to 4%. And in fact, 4% was exactly, there's a different measure, the core CPI, that's where that was today. So if you take the volatile parts out, the sort of steady, this is really what's going on underneath inflation, looks like it's more 4%. Well, if you went from 5% to 3.8 or 4%, you don't really get the sense we're almost done, that we've almost solved this thing. And I think that's why you're hearing the Fed statements. We'll be getting a Fed statement within a day, but that's why you're getting these Fed statements saying higher for longer, we're not swearing off this. But I will say that at the moment you have a real disconnect between the Fed and markets on that markets are more convinced that you hear some of these cheery inflation numbers, the Fed must be done. And I would say this is really the big game going on right now. If we go to the next slide, and by the game, I mean what's going on with policy. Here, the next slide I'll show, this is what the Fed has been doing throughout. Actually, one of them is what the Fed's been doing. The second part is what the markets do. So the red line here shows the effective Fed funds rate. This is the one that everybody's saying, are they going to hold steady? Are they going to raise? Are they going to lower? It's the thing they directly control. That's why it makes headlines, but it actually affects very few transactions. That these are the transactions that are going on very short term between banks. If you think about things like at what rate can a business take out a loan, or what's your mortgage rate going to be, those tend to be based more on longer term interest rates, and those are the ones that are set by markets. So as sort of the king of all of those, I've put the 10-year Treasury yield, which is the blue line that you can see going across. So when we start this in the beginning of 2022, it was March of 2022 that the Fed started raising. You see the Fed funds rate, the short rates are lower than the long rates. That's normal. People call that a sort of yield curve when you map out all the rates. And then what you see is for a while there, they're both going up. And that's kind of the idea of when the Fed raises rates, how is this transmitted? Even though businesses aren't borrowing from the Fed, it affects the other rates, and therefore the businesses will be affected. Higher rates should slow everything down. That goes on for a while, but if you look, just as we're actually getting to about the start of this last year, we're doing a year in review, of course, what you see is while the Fed keeps going, the bond market says, no, I think that's about it. We're going to hold steady. We're not actually increasing the costs at which you're borrowing. And that was true for about the first half of the year. You see right under 4%, you've got the 10-year note really not doing very much. There was a little while then for the, from the summer of 23, we went up to about 5%. And for a while there, it looked like, yeah, the markets were convinced that the Fed means it, higher for longer. But look at the very bit at the end. You've had pretty substantial loosening, and we've been, I think I didn't check today, somewhere around 4.2%. So that's really the costs to businesses. It looks like the Fed has tightened a lot. If they don't have the credibility with the markets, and if the markets don't believe them when they say higher for longer, you haven't really tightened that much. Why do we care? Because the theory is you're not going to get rid of that inflation unless you actually get tightening, unless this gets transmitted to the markets.
Phil, how much do economists today believe in the independence of the Fed, and is there an impact of the election that's coming up and Biden, the wanting to keep the economy hot so that for a reelection run?
I think economists do generally believe that the Fed operates independently. That said, you're right. You're right to ask about the presidential election. I think what the Fed would like, if they could, is to be neutral in the whole thing. The problem is it's not clear what neutral is.
Mm-hmm.
If you let policy be looser than it ought to be, is that neutral? By doing
inflation.
nothing?
Yeah, people feel it.
Right. And so it's, I think their goal is that they don't have a safe harbor in this one. I don't think there's an easy thing. What I would note on this, one of the things that's going on here, the trick for the Fed, as they do things like raising these rates, they're not thinking, okay, I'm going to do this and here's what inflation is going to be in January of next year. They're thinking, I'm going to do this and here's what inflation is going to be in June of 25. That we normally think that monetary policy is working with somewhere between a 1 year and a 2 year lag. And that's hard because how do you know what's going to be happening a year and a half from now? If you've got models that work really well and are really accurate, okay, that helps. What we've really had over these last few years is the models have done terribly in terms of predicting where the inflation was coming from. And so then you end up kind of groping your way through a bit. And so that's why you get these big discrepancies where you'll even see Fed governors and regional Fed presidents, some saying, I think we're done, some saying, no, we need to do more. That's why you have this. They won't overtly say any of it is political, but of course they are political appointees. And so they come with, certain preferences that people know. How much do you care about potential unemployment that would come from tightening, for example?
Yeah. And so, hey, how do we tie this to the logistics markets and trade? Because some of this is all second order and third order effects, and it's like such a complex system. So I'd love to see, hey, how does Phil, Levy, and other economists think to go, all right, what does this mean for price of freight or the amount of inventory?
Okay, so let's skip ahead. Let's go to the inventory slide.
Yeah. Sorry to disrupt your flow, but I think it's so fascinating.
Okay, so let's see. There we go. Wholesale inventories. I'm going to use this to make a different point later, but I like the question that Ryan just asked. This is one of the sort of key things that's been going on with the industry. What we skipped over and we can come back to is you've had consumption stay reasonably strong. Ryan, I don't think you or anybody else would say that shipping has been really strong this past year. Nope,
volumes are way down.
Right, exactly.
Not Flexport volumes, by the way. Our volumes are up, but the industry volumes are down.
Of course. But although good to make clear. But then the question is, this on the face of it might represent sort of a discrepancy. How do you have it that consumption is staying pretty strong, but shipping is way down? Isn't it shipping that feeds us the goods that people are ultimately consuming? Well, we have inventories sitting right in between them. And one thing I will note, and this is so I'm being directly responsive to your question, the cost of inventory has something to do with interest rates. That's not the only cost of inventory, but it's part of it, right? If you're going to buy a whole bunch of goods now and you're going to sell them 6 months from now, you needed to put the money out, and it's a while till you get the money back. So it's borrowing. So if you're doing this when interest rates are very, very low, 2%, it's a different story than if they're 5%. And so the reason I wanted to come here is that we had seen you've seen a lot of movement in this. That the story we had here was there wasn't exactly a pre-COVID norm. You got a decent amount of bouncing around as you look sort of end of 2018 into 2020. You get a spike that comes up. Well, it's inventory to sales. It's a ratio. If sales drop off, the whole thing is, which they did, in the immediate onset of the pandemic, it goes way up, but then it goes down. And that down is as we get our consumption boom, and as it got really difficult to move goods, as it started to take a long time to move goods. So then you had inventories to sales well below. I'm doing this, by the way, for wholesalers. You can look at it for retailers. There's various ways of looking at it. I picked this one. So you saw through about the beginning of 2022, we're bouncing along at unusually low levels for inventories. And then this starts to climb. And it climbs and climbs until just about this summer. And this is presumably, as goods are coming in, they're coming in faster, things have loosened up. And meanwhile, it wasn't that sales fell off or consumers went away, but they may not have been going at the rate that retailers were hoping for. If you were thinking that you were going to have tremendous acceleration, and instead what you had was good, solid growth, you may have overbought for that.
Or you bought the wrong stuff. You see a lot of that too.
Good point. Yeah. So for whatever reason, you ended up with more inventory than you wanted. And that's how you can reconcile this discrepancy, where you're seeing fairly steady consumption, but people are trying to burn down inventory, so they're not placing new orders.
It's fascinating. You can tell the whole, this the whole story of the shipping industry and logistics in this one little graph right here from whoever this guy Fred is really on point.
He's a gnome who works in the basement at the St. Louis Fed.
Is this like where people named Dennis end up becoming dentists and people named Fred end up in the economics industry? It would be worth studying, Phil.
And it's actually an extraordinarily useful database that the Federal Reserve of St. Louis puts out that that lets you to get data from all over the place and present it very nicely. So tip of the hat to the St. Louis Fed. Here's the trick on all this, though, Ryan. What I'm sure you would like to know, I would like to know, we would like to know is, all right, at what point do inventories get back to the level where everybody says, there, that's it, I'm comfortable, I need to start placing orders again? And that's also where the interest rate question comes in. Because the question is, you and I can both look and we can say, I don't know, eyeballing it, the pre-COVID average was 1.35, something like that.
Yeah.
Well, I think we're actually a little bit below that now. So we're there, right? Well, maybe the difference was that was in a very low interest rate environment, and now we're in a higher interest rate environment. So maybe the target is lower than this. I was just talking to somebody this morning in the auto industry, and their story was, you're not seeing as many cars on lots, and this is something the industry really likes. Some of that has to do, they said, because interest rates are high and this is costly. Some of this is just, it's a more profitable way to run the business when you're not maintaining.
That's fascinating because, the story coming out of the pandemic was, hey, we all learned the cost of not having enough inventory, and that'll never happen again. No more just in time. We're all going to have safety stocks and make sure it's there. But that doesn't factor the high interest rates and what that does to your economic model. If you're sitting on unsold goods, they're burning, 8, 10, 14, 12, whatever your interest rate is, can be pretty high these days.
Yeah, no, you're absolutely right. I will say I was sort of skeptical of that when they said it, because it way oversimplified the challenge that businesses face, right? Where the trick is you can lose in either direction. If you have tons of customers coming in the door and you don't have stock on the shelves, you lose sales, and it's a real problem. But it is also very costly if you get a lot of unsold stock. As you said, you get seasonal stuff and you move on to the next season, and then what do? Hold it for a year? And as interest rates go up and as warehouses get full and warehouse space gets tight, this gets to be a real problem. So anyways, this is my linkage that I will put forward between why we care about interest rates, because it's directly affecting business costs for those things where you need to hold something and wait.
Phil, I wish everybody, when I asked them a question, just pulled up the perfect graph to answer it. That was great.
Well, I do my best. All right, let's go back, because I've been making these claims and waving my hands in the air about the consumption stuff. So I want to go back to my favorite consumption thing, because this is a little bit sort of setting the scene. And it's almost, there we go, this one, perfect. This is something that regular followers will have seen before, except we've updated the data. This is taking the big components of personal consumption expenditures. And remember, by the way, consumption is something like 70% of the U.S. economy. So this is a big chunk of what's going on in the U.S. economy. This portrays it as if these three segments, services, durables, and non-durable goods, are all equal. They're not. Services is something like 2/3 of consumption. Of the remainder, non-durables is about 2/3 of that, and then the remainder is durables. But what I've done here is I've normalized them so that February 2020 equals 100. So you can see, what does everything look like right on the eve of the pandemic? And where we wrote that. Before we start seeing what played out, the thing I will note is that part on the left is boring. By that I mean the norm was these things just didn't move very much. You didn't get wild swings. So if you were a business operating in this environment and you were saying, let me plan for a 1 standard deviation or a 2 standard deviation move, you wouldn't have been looking for anything like what you see on the right. That it's way more variation than what we had seen before. The next thing to notice is all of these things took a dive essentially during the pandemic. And so, what do you do? Say, Ryan, you can actually answer this. If you're in the logistics sector, you're a shipper, and all of a sudden you see, look at those things going down. People aren't consuming. If I'm a carrier, what am I going to do? Presumably, I
Well,
try to cut back, right?
if you could, the problem with the carrier's life cycle is that the assets, yeah, they have a 30-year life cycle. Man, I don't know how you predict anything 30 years in the future.
Well, that's right. Well, we've seen blank sailings and stuff, but you're right. Temporary; those are band-aids. Those are not real fixes.
Hey, there's kind of a narrative violation here with the durable goods still staying so strong. I really thought they'd be tied to home sales, and we've seen such a shrink. With the high interest rates, people are kind of locked into their house and not selling, not
I know
buying and selling. The market's kind of frozen. I would have expected looking at this that durable goods would be going way down in the last year.
everybody expected that, and that was
Hmm.
kind of what the Fed expected. When you ask the Fed in say 21 or 22, why are you guys not so worried about inflation? They said it's transitory. You look at the big spike in durables. You go and you buy next year's sofa this year. Okay, well then you don't need it next year, right? These things should drop off. That's the whole point. These are goods that last 3 years or more, or your big screen TV or whatever. And so yes, that is a really big surprise. Is that durables consumption? Well, it went extraordinarily high. What you see, and this is my big claim, by the way, that where I take odds with a lot of people. We talk about the supply chain failing. I think we had a demand crunch.
Yeah.
And part of what you can see is look at the goods here. So the green part is services, and we don't ship those in containers. The stuff that we ship in containers are the next two lines. And by the time you got to early 2021, where were we? If this was really a supply chain failure and people couldn't deliver the goods, those should be down below 100. Instead, by the spring of 21, we are seeing durable goods up over 30%, and we're seeing non-durables up over 10%.
Yeah, no one denies we ship more than ever before. Because hey, we want to ship as much as we possibly can. We know, that's not you're not doing your job if people are trying to ship things and they can't. But I get your
But this is
point.
a general business problem, right, Ryan? That
Yeah.
if I tell you build something, what capacity do you set? And that's where we get back to this thing of how much variation had you seen in the past? Do you plan that,
No, yeah, you can't just have empty assets sitting around unused, though. You go bankrupt when you do that, especially with the higher interest rates today. So,
exactly. So what you saw really steady growth, and I'll show it in a second. It was not just in consumption; it was in imports as well. We did see steady growth, but just not to match it. The other thing I would note here is if you were looking at this in the spring of 21, you would have seen, wow, look at this. We dipped from in durable goods, say we were about 80, and now we're at 132. I can project that on to where we're going to be at 150, by the time we get to 23. If you just sort of took a line and extended it. Now that's
well,
not what happened,
yeah.
right? But if you had that super optimistic view about sales, like, hey, look, I've already gotten caught out once where I had bare shelves. I'm not going to get caught out again. I'm going to get ahead of this thing. I'm going to extrapolate recent trends. That is a reasonable way where you could end up with too much inventory. And it's, what happened to consumption? Part of what's interesting here is what didn't happen. It didn't fall off a cliff, right? We didn't have the enormous pullback. The levels, and this is what you mentioned right at the beginning, the levels that we stayed at are actually high levels relative to where we were before. We're consuming a lot of goods. It may just not have been what people planned for. And you raised a really good point, Ryan, which is I think one of the things people thought when you were seeing these, the long times to deliver stuff and the difficulty of getting stuff was, why are we not getting a market response? Why do the carriers not order more ships? So why didn't the carriers order more ships?
Oh, they did.
Yeah, exactly.
Massive quantity. It takes a couple of years to build a ship. So it's a bullwhip effect. And asset-based industries are so tough. As I was saying, you've got a 30-year, 20 to 30-year asset lifetime. And it takes 2 years to make the thing, and you're trying to plan over that long time horizon. And
have we started seeing those ships come on?
Yeah, you have, and you'll see by the end of I think it's around 2020. So we should have that graph, but we can share it in the post slides. But when we share this out, but the order book is sort of by 2026, you'll have about a 25% increase in the number of container ships, or the capacity of the world's container shipping fleet, which is just a massive increase. And we're not seeing, this durable goods, a lot of these are made in America. And so you're not seeing this is not actually reflective of the container shipping volumes. They're not up this much. And so it's certainly not enough to absorb 25% capacity increase. We'll talk about when we get to some of the trends.
Let's switch the slide to the U.S. trade slide. I think it's the next one right after this. But even this is not quite the one to make your point. So you do see the pullback here. We've got imports on top, exports on the bottom. This is in real terms. But you're quite right that this mixes in some of the things like trading petroleum.
Yeah, exactly.
Industrial supplies, which tends to mute the effect you're talking about. If we did consumer goods, it would be a lot more dramatic that you would see the pullback that we got. So you're right that whereas durables consumption had stayed reasonably strong, and that was exactly why I was turning to the inventories, because how to reconcile those two. But the consumption had stayed strong, but the trade really notably fell off. And as I said, this is being held up by things like petroleum products. So yeah, do you want to take this moment to sort of talk about what this last year felt like in the shipping industry? Was this, I mean, we posed this question in the beginning. Was this like back to old norms? Is this a new norm? Where do you see this? Where did 2023 put us?
I think on the ocean freight, when you look at rates, we're back to normal kind of pre-pandemic levels with the same kind of pre-pandemic levels of, it's going to go up and down. There's going to be rate increases from the carriers. We just saw one this week, but we're at a kind of long-term historical average, maybe even a little bit below. If this latest rate increase sticks, the carriers should be in a healthy place. But it's been at levels where it's perhaps below the marginal cost for these carriers and not sustainable. And that's the nature of that business over the last 30 years. They made a ton of money. We all know this over the last 2 years, but that was preceded by 10, 20 years of just losing money. Well, 10 years, let's say, since 2008, 10, 15 years of losing money. And it's also part of why, these carriers, there's not that many of them. They tend to be either family run or sort of national champions, because a typical Wall Street firm just can't handle the level of a decade of losses. It's just tough for an equity investor, and they end up in the hands of families that have longer term time horizons, or countries that say, hey, this is a strategic asset. If I'm Korea, Japan, some of these countries, they want to make sure, even Israel has its own carrier, make sure that, hey, that they see it as a national interest and strategic interest. It's interesting that the United States doesn't see it that way. We don't have any ocean carrier based in the U.S. But yeah, the prices have come back down to pre-pandemic levels with the increase in capacity that's coming online. We should expect that to stay. I would expect ocean freight rates to even come down. And that's not, I don't have a crystal ball, and I'm not the best at predicting these things, but you hear it from the carriers themselves as they published earnings or made statements that they foresee lower prices, just the amount of carriers that have amount of capacity that's come online. But certainly there's always potential for some black swans, and almost by definition, you can't predict those. But there are a few things that we can sort of look at and say, hey, let's keep an eye on these things that may reduce capacity for the ocean fleet. One is, of course, the Panama Canal congestion that's caused by a drought. Very hard to predict such a thing, but it's happening now. That reduces the flow to the east coast of the United States from Asia and vice versa. That anything that reduces capacity increases price in theory, right? Reducing supply and reduces transit time and all of that. Another one is in the Suez. Just yesterday or even this morning, I don't know, I learned about it this morning, a missile hit an oil carrying palm oil, but like a bulk tanker going through the Suez or down by Yemen. That's definitely something that we need to keep an eye on as an industry, because if they start diverting ships around the Cape, that's a huge go around that can really reduce supply, increase costs, and frankly, like a lot of these big container ships don't do that well, is what I'm told. Never sailed on a container ship south of South Africa, but I'm told the waves down there are pretty big and don't do that well. So, but if insurance companies start really ratcheting it up or refuse to insure ships going through the Suez, that's going to just be a huge impact. And this is where you see ocean rates and air rates tie together, because if it starts to be unreliable to ship by ocean from Asia to Europe through the Suez, it doesn't take a lot of containers switching from ocean to air to fill up the world's planes and absorb that cargo capacity. Very simple. Seven containers fills a 747, 7 or 8, depending on how your load factor. Right, and these ships have 20,000 containers, so it just doesn't take a lot to absorb. I think there's 600 747 cargo planes in the world, and about the same amount of belly capacity. So it just doesn't take that much to fill them up. So that's something really to keep an eye on, and for the air market.
So Ryan, staying with ocean for a second, you mentioned the Panama Canal as one of the things that people had to focus on. Maybe one of the stories of this past year was the extent to which people had to think about, were they shipping to the West Coast or were they shipping to the East Coast? What did you see with that? Because remember, the initial concern had been, say, with labor negotiation. Were you going to have trouble with the West Coast? We might have thought that that was a very difficult thing to do, because so much of this has to do with what happens after a container arrives and it has to feed into a network. What did we learn this last year about that ability to be flexible this way?
Well, yeah, there was earlier in the year, people really wanted to ship to the East Coast to avoid ILWU, the West Coast Labor Union, if there was any work stoppage or strike. They got that negotiation settled. I think it was a 35% pay increase, and of course, no more automation on the West Coast for a number of years. Then what you saw is in September of this year, this is the one that really caught me. I was like, a narrative violation, where September, Long Beach and LA set the record for number of containers imported all time. And I was like, wow, I thought imports were kind of down year over year, certainly not all time versus the last couple of years. But what you saw was all the East Coast volumes say, hey, let's just come to the port of LA and skip the Panama Canal and either go across the rail or truck it. And that calculus was changing. So that's what explains these record volumes that you started to see. And so, the world does adapt reasonably quickly to these types of shortages, and the timeliness indicator that we publish here. This is a Flexport index that Phil's team creates. And so, yeah, you definitely see that. Now there's a new one is, the U.S. labor unions, there's a different, the West Coast is longshoremen are represented by the ILWU. The East Coast is represented by the ILA. And the ILA sees the West Coast contract that was signed. They're up for renegotiation now. And definitely something for us to keep an eye on, because they're not happy with the terms. They thought that they should get even more than the ILWU got. That's the scuttlebutt that I'm hearing, is that they're going to hold out pretty hard for negotiation. And very interesting to see what the ocean carriers, fundamentally, that the negotiating group is going to be a consortium of the ocean carriers negotiate as a group with the with the ILA. And very interesting to see, what's their willingness to make a deal. Do they call the bluff? And so I think now East Coast, between Panama Canal and risk of shortages, I think the East Coast is going to be a tough place to make predictions about and want to plan your supply chain around shipping through the canal into the East Coast right now. So I think you're going to see more and more volumes on the West Coast, and put things back under stress the way it's been in the past. And if they go on strike on the East Coast, I think you may see similar types of situation where the timeliness gets pretty bad, because we know, you now have some data to go back. In the past, we didn't really have. The problem with all data, it comes from the past. So if your future doesn't look like the past, you don't know. We never had data to show, hey, what happens when volumes go up 20% in a 1-year period? And now we kind of do. So you might be able to model that and say, hey, you're going to have a lot of shortages or a lot of bottlenecks at the port there on the West Coast again.
Yeah, and I'm glad you already explained why I don't have this whole set of charts for 2024, because we don't have that data. You had mentioned earlier that one of the sort of themes that the lessons people had taken from the pandemic was, do you do just in time versus just in case inventories? We already dealt with that one. A second thing when people talk about supply chain reliability was sort of multi-sourcing. And you could actually add to that multi-sourcing and multi-routing. So do you see those as solutions? I mean, are those things when somebody says, hey, you just told me that I might have labor trouble on the East Coast, there might be canal trouble, should I hedge my bets? Should I do multiple things? If I'm a company, how do I deal with this?
Yeah, absolutely. And We definitely have recommended that to the clients over the years is as we adapting to potential issues like the ones we're describing. That will say, hey, you want to have some level of capacity on a contract that's flowing in that on both to both coasts, so that because if you have a bit of a fixed capacity there, then it gives you the ability in general to start going to these carriers and flex up and say, hey, I'm already doing some volume here. Now, get me additional capacity on the spot market. So that's definitely part of what our ocean team would sit down and do a planning session with a customer and say, okay, let's actually look at what some of the risks are. Certainly, those are things that are on our radar. The ones that I mentioned, ILA, the Panama Canal, Suez, and every company's different. And ultimately, looking at where it's going to be driven mostly by where your distribution centers are and what's the best way to get there via the rail or truck, and which ports and what the cost is. But yeah, you got to plan for these edge cases. That's one thing that the last few years have taught us.
Yeah. Okay. I also want to hit you with this graph, which you've already introed very nicely. This was a way of measuring out of all the other stuff we talked before. What did this end up meaning for logistics? Yeah, we put this measure together saying how many days was it from cargo ready date to destination port departure. If we were doing the year in review 2021, it would be, wow, this got much, much worse. If we did the year in review 2022, it got dramatically better, although not all the way back. You look at 2023, and it's a bit of a mixed story that the two lines represent two major trade lanes. There's the Trans-Pacific eastbound, the dark color, and then the red is the Far East westbound. You note that pre-pandemic, geography being what it is, there was a gap between these. That kind of went away during the pandemic but it sort of reappeared in 23. The other thing, at least to my eye, two other things that are notable on this. One, to the extent we leveled out over the year, we didn't level out at the number of days that we were at before. And two, actually, you look at the end, and this actually looks like a little bit of an upswing. It's hard to sort of see this as trending down later. At least for my purposes, there's some unanswered questions here. These are things that we sort of have to keep puzzling about. So I'm going to invite your guess, not your answer. It seems some candidates are the stuff we were just talking about. When we do this, we average, East Coast, West Coast. It's each one of these is sort of Asia to North America or Asia to Europe. So you could have compositional effects. I've talked with some of our experts. There's, another hypothesis is blank sailings, that if you were going to be shipping something and all of a sudden that sailing is canceled, that of course adds time to your whole journey. What is your sense of what we're seeing with this and why this did not just sort of bounce right back to the norms? You said prices kind of did.
Definitely a lot of blank sailing. Blank sailing is when a carrier cancels a sailing, cancel, and say, okay, you basically have to wait till the next week or the next sailing. Seen a lot of that, trying to manage capacity. I think it's well known there's just more capacity than the market can absorb, and one way they can do it is idle ships and blank a sailing. So definitely that's part of it. But in general, I don't think this is a satisfactory place for the industry, and I think there's a lot that an individual company like Flexport can do to drive this timeliness and drive the efficiency and make sure you're actually getting those shipping orders released and getting it onto the ship as fast as possible. So,
yeah. No, something to aim for. All right. Any last thoughts on 2023 before we go ask our audience to start thinking about 24?
Well, the biggest one, and I mentioned it briefly earlier, was about the thing that's blown my mind. I just got back from Asia. I spent 2 weeks in Asia, the last 2 weeks in 6 different cities in Asia, kind of a whirlwind tour of Flexport offices over there, and meeting with airlines, meeting with all kinds of companies. But the airline meetings were so fascinating to hear the growth of the e-commerce business of parcels coming over. Now Flexport provides this service for 3 of the 10 biggest e-commerce players in Asia, flying cargo to the US and then delivering it directly to customer stores. So I knew about it. I mean, obviously we're in it. We're working with some of the biggest companies in the space, but hearing from these airlines, I thought we were unique. Hey, we're crushing it. We're doing a great job in this industry, in this market. It turns out it's between 30 and 50% of all the all the cargo capacity flying from Asia to the United States right now is e-commerce parcels. And that is just a huge shift. I don't know I don't have a benchmark on that. I'm studying it because this is like our team at Flexport's been really excited about this for a long time. Got these great customers, but it was just kind of hearing it directly from heads of cargo or presidents of these airlines going, yeah, it's 30% of all our volume. Oh, and by the way, the biggest brand in that space, Temu, is projecting 100% growth year over year. And other ones are in the, high double digits as well. So that's so crazy growth because the certain, and you combine that with what I was saying about the Suez, if you have ocean freight kind of converting over to air freight, it's going to just eat up the capacity and keep these rates very high. We saw the air freight rates this year were incredibly low all year. And then this, a lot of this e-commerce stuff is kind of peak season driven. And that's where we are right now. Black Friday just happened. And it all of a sudden, just this huge surge in volumes that sent the air freight price kind of up 5x from lows earlier in the year. So we're on the air freight side, we're at this crazy volatility, caught a lot of companies by surprise. It caught everybody by surprise in the industry, frankly, including us, and had to kind of push price increases. I heard this from all kinds of customers that their freight forwarders, their air providers were increasing their pricing over the last month. And that is expected to just grow next year. Now, I do think it's very volatile and peak season driven, but people need to plan for that next year. If you have air freight in the peak, you're going to, we talk about what next year looks like. I think planning for, a complete lack of air freight capacity to absorb that growth should definitely be on people's radar.
Hey, let me follow up.
And one thing to add that's driving this, I mean, I'm still trying to understand it, but part of that is the de minimis exemption, which is if you import something under $800 and it's consigned, labeled to the final consumer, you don't have to pay duty on it under U.S. customs regs. And so that's a big deal, right? I mean, the duty rates where they are on the 301 tariffs of 25%, and you avoid that completely if you go and you fly directly and inject directly to the customer. You don't have to fly it in. We see a lot of companies putting fulfillment centers in Canada and Mexico along the border and fulfilling into the U.S. with, then you can just do ocean freight into your fulfillment center and inject that way. But that's a big driving factor for it. I think these Chinese companies are really, really good at marketing on the internet, getting customers, viral sort of social media type apps. TikTok, of course, is a phenomenon. And you're seeing that is a big driving factor here is the tariff regime. And I've got our government team looking at it, and there's a couple bills in front of that will be in front of Congress over the next couple of years that might put this at risk. One specifically targeting Chinese exporters, which would be, I'm told, more likely to pass. But hey, I have no read on Congress. That's not my area of expertise by any means. But something to watch for, certainly for the next year or two, and then we'll see how the government responds if they respond. And just the business model of the companies, it's like things they got to be making money for it to last for the long run. But definitely for next year, it's something to keep a real eye on.
Okay, we're going to get to things to keep an eye on for next year. One thing I wanted to pick up on, though, because I'm an economist, and when you start talking about prices, I get excited. One of the things we saw when things were really, really tight was that people tried to push for longer-term contracts, right? How long you would sort of lease a flight or vessel. Has that stuff all worked its way out of the system now, or are the markets still being influenced by these longer-term contracts?
I'm glad you asked that. No, there's still a lot of long-term contracts out there. And people, part of what led to very, very low prices earlier in the year is forwarders and had signed long-term, we call it block space agreement in air freight. Actually, now in ocean freight too, where you have a longer-term kind of hard commitment to buy that space, whether or not you put any cargo in it, you're going to pay the airline or you're going to pay the ocean carrier. And if you've got that, it's a sunk cost, and so you should sell at whatever price you can get. If you don't, it's a perishable good. That ship's leaving, that plane's leaving, you just sell it whatever. And that led to people selling well below marginal cost in parts of this year where there was no demand because they just didn't have any other choice. And you might as well, even if your marginal cost, you're committed long-term to pay $5 a kilo, just take two. It's better than flying it empty. And so you saw a lot of that going on in the low points of this year in the air freight market. And that's very, you have to be very cautious as a brand. I mean, if you can save $3 a kilo and you're shipping millions of kilos, hey, you should do that all day long. I advise a lot of customers to do that. But you should also know if that forwarder's losing money, the moment they'll take your business today, but tomorrow they're going to be looking for another customer who will pay $2.50, and the day after that $2.75, and they're going to keep trying to work their way up. So you won't get reliability. Fundamentally, anytime you're buying freight, you want to understand the P&L of your counterparty, because if they're not making money, it's not a deal that's going to last. And at the end of the day, the reason to sign long-term contracts is as much about reliability and making sure that when peak season comes around, you've got capacity and you can deliver your product throughout the year, and make sure the reason to pay for air freight is timeliness, obviously. And so it's always a trade-off, cost and timeliness, as it is in everything in this world, right? And quality and cost and speed. You got to pick two.
Yeah. Well, that's interesting. Well, it's good to understand the underlying dynamics. All right, let's go to our second poll question. There are all kinds of good things to talk about. We're going to start looking forward. So, as we ask all of you, we start looking ahead to 2024. Do you expect to ship at about the same level you did this year? Do you expect to increase your shipping, decrease your shipping, or it's not so much about more or less, but about reworking my supply chain? That things just have to be done differently.
And if you don't ship anything, just don't vote. How's that?
Yeah, fair enough. That sounds like reasonable. All right, so we get an interesting split here. Votes are coming in, but it's pretty evenly divided. So very few people, encouraging for us, saying they're going to decrease their shipping.
Let's go.
That's right.
Increase that shipping.
Okay, so now the increases are out in the lead.
Go increase, keep going.
Yeah, exactly. We have a vested interest in all of this. Is this about? Is that when you look forward to next year? Is this is that your thought about you could tell a story where if those inventories are going down and all of a sudden they hit the point where somebody says, okay, now I need to restock, you could get a decent pickup.
Phil, I've been doing this for now going on 11 years since we got our first customers. Not that long, but it's long enough for me to know I just don't even try to predict that anymore.
Okay.
Be ready for whatever may happen is the best answer.
Well, you know what? So before we get to, and you've already, previewed some of the nasty things that could happen, I want to take it in a little bit of a different direction to start with, because part of your founding premise, company, was technology is a big deal and you could bring technology to bear and there's room for this. When you look ahead, and let's do near term, so 2024, what's exciting about technology out there that you think matters for the logistics industry?
Well, it's obviously AI, and not in some generic kind of, let's talk about the future and pretend we're geniuses or something, but very tactically, what you're seeing right now is that OpenAI's APIs and a few other startups that are right on the heels of them, and maybe even better in certain enterprise workflows, are able to do a lot of the tasks if you can simplify it enough that go into logistics. And that's the key, is if you can simplify these tasks so that, shipping a container from Shenzhen to St. Louis is like a complex undertaking, but taking an ocean carrier contract and digitizing it and putting it in a database is simple enough. And you're finding that things that were sort of intractable over the last decade when it comes to automation we're finding them to be susceptible to AI-based automation, and on a very regular cadence. And that's actually incredibly exciting for anyone in the industry, because freight forwarding, if you look at the P&L of a freight forwarder, any freight forwarder out there, about 10% of the total cost of what you pay for shipping a container, about 10% of the cost goes into the operational labor component in the freight forwarding layer, not in driving the truck or flying the airplane, loading the ship labor, but just coordinating the shipment. I call it freight email forwarding, passing documents around, and data, right? And connecting with the asset owners and making the stuff move for you, for those customers. That 10%, you can lower that meaningfully. That's just a huge boom to the shippers in the world. That's a huge opportunity to save people money, make it even easier to, and fundamentally make freight forwarders more profitable, make the industry better, make it cheaper for our customers to ship. So I think that we should really have our eyes on that for what AI can do and surprise us in the next. I'm getting surprised every couple of weeks by what it can do for us.
And what's an example of the kind of thing where you see this potentially helping? Is it routing, for optimal routing?
Yeah,
Where
the best use case I've seen at Flexport so far is that one I mentioned is the ocean carrier contracts, and like this one is less about saving labor. Like, look, it's a couple of people that digitize a contract. These contracts come from an ocean carrier in a giant Excel file with thousands of rows and tabs and if-then statements and subject to charges. They're actually hard. They're very hard to understand, as you can imagine, even for a human. And it was taking it. We try to have like 24-hour turnaround. Sometimes it takes a few days to actually get those rates into the database, and the rates aren't valid for that long. The rates are always changing in this industry. And so if you lose a couple of days of validity, that's actually more important than the cost of the digitization. And so OpenAI, we're able to just digitize in like 5 minutes, get it into the database, and it's as accurate or more so than a human digitizing it. And we've had parsers, we've had tech that extracts this and feed, from the Excel files and puts it in the database, but they always are breaking. And so you have this constant, it's actually as much of a maintenance challenge with software engineers as it is a data entry team that you're replacing when you do that. So that one's big. Another one that is really, really big is that every single week at Flexport, we have 1,600 changes from our customers to the date that their cargo is ready. Manufacturing just gets pushed. On average, it's 1,600 a week. And in the past, what that meant would be I might be canceling 1,600 bookings with an ocean carrier and saying, I'm sorry, I don't have the booking that I thought I was going to have. The cargo wasn't ready when it was supposed to be. Now, we would do our best to use statistics and data science to get the optimal number of bookings so we're not canceling. That was how we built our brand with ocean carriers over the years, is cancel at a much lower rate than the competition does. But now we're using AI to do this. And the reason you need AI is because a human being that's planning these containers and putting them, you fundamentally have a choice. Which ship should it go on when it's ready? And then if it gets canceled, I got to go, okay, dang, that stinks. Now what happens is the AI replans every container in the network 10 times a day and finds a future container and says, hey, this thing will actually be ready. Let me pull it forward a week. And so the result was a 20% increase in on-time performance for our containers that going through the planner, which is now all the containers coming out of most ports in Asia for us. 20% on-time performance, which is just massive. Lowering our costs because we're finding the cheapest contract available that will hit the customer's transit time, and lowering the cancellation rate with carriers pretty dramatically to get it to the industry's lowest. So again, just a huge breakthrough from AI, and not, I don't want to downplay it because it took years of work to get the planning systems and the data in the right place and have the core infrastructure, but the AI itself to apply it, I think, is more or less off the shelf. So these are just examples. Lots of them we're just finding tracking containers. If the best source of data is on the web, AI is better at going to these web and scraping it and finding the container tracking information and putting it in our database than a scraper would be. A scraper is a kind of like basically a bot that goes there and pulls the data in. Those tend to break a lot, whereas the AI is much more adaptable if the carrier website changes or something.
So Ryan, you're summoning up memories of when I was about to join Flexport, and somebody who was a little bit cynical, a colleague, said, oh yeah, they're the ones who want to get people out of the freight forwarding business. That's not what you're imagining, right? It's not that we sort of get this and then there are no people involved in it.
I want the people to spend all their time on relationships and solving problems and doing things. I mean, look, AI might really it is blowing my mind day by day, but it's pretty far away from replacing a human relationship. It tends to kind of, if you give it a more complex question or problem, it's still kind of hallucinating and giving you crazy answers. And so you want problem solving based people. The AI is not going to predict what happens with the ILA and how to manage, against that. Maybe you could put in the right, hey, look, I'm not going to downplay anything on a 10-year horizon, but over the next few years, I think the role of people is just more important than ever people are much more agile than software systems. People are much more able to just quickly change. It's why the iPhone's made by people and not by machines, is because they're changing the iPhone every week with a better spec, probably. I don't know the detail, but I think they change constantly to improve it. throughout the year. It's not that the iPhone when it launches is the same as a year later. They're constantly upgrading, and that if you have to retool your whole factory, it doesn't work. So people are just much better at huge numbers of jobs. But the AI is surprising us. I read some economist, I believe he was an economist, wrote this paper kind of like 10, 15 years ago of like which jobs are most likely to be affected by automation, and freight forwarding was like one of the top three. But it's been much harder than I would have said. Over the last decade, we've been working on it, but we've set ourselves up for success finally with AI because we've structured so much of the work.
Okay, we've had all kinds of fun things to talk about. I want to at least get in one audience question before we wrap things up, and then we can sort of, in our closing comments, give a couple of final thoughts for 24. But first, this audience question, do you see forthcoming changes in sustainability as a priority in supply chain?
Absolutely. I'm glad, because that was going to be one of my forecasts for 24. So that's a good segue. For sure, we're seeing a lot of it coming out of from the regulators. I think there's some demand from top end brands for this. We see a lot of our customers buying. We've got a sustainable aviation fuel offering and ocean freight fuel offering, SAF. But it's the demand isn't there to pay at those prices. I think for you in mass, the figures that I was quoted by an ocean carrier a couple weeks ago was that it's something like 8 times more expensive for biofuel per unit of energy, which is the ultimate thing. You don't want to just look at per gallon; it's per unit of energy produced. That you're just not going to get a huge amount of demand for mass market at those price differences unless the government kind of enforces it. You're going to see the belief amongst ocean carriers, you will see those types of regs. It's going to be very interesting to see which carriers are able and willing to invest against it, because they have to replace the fleet fundamentally with different types of ships. The big question mark in my mind is, okay, that's the current price of biofuel, but when you have a 10x demand for it, what happens to the price? Is there enough production of this stuff? And the answer is probably not, right? I haven't done enough of the first principles physics to go, do we produce enough corn to convert it all to biofuel? But I have my doubts on that. But you definitely see regulations, and it would not be the first time that a regulator just did something without understanding all the second order impact of what they do. To give you an example, Fiji is currently served, the island of Fiji, the country of Fiji, I should say, served by ships that don't meet those new standards. And so if you were to instantly pass these regs, and they would say, hey, you can't, if you're emitting more than X carbon, you might actually cut an island nation like Fiji off from the global economy. And we're worried about flooding some of these island nations, but I think we also have to be worried about what happens if you send them back to hey, no more shipping for you, and no more Fiji water for all you coastal elites. It would be, I think the regulators have to really think about that, and I don't know if they are.
Yeah. Okay. Well, interesting sort of thing about it. We are just about out of time. Do you have like a closing thought, things to look? I'm going to tell everybody, watch out for those interest rates kicking in, and we'll see what happens. Also, watch out for trade conflict. You have a final?
Yeah, Phil and I are we can sound like experts, but there's definitely more expertise at Flexport. There's a whole webinar series. I'd encourage people who want to learn more about what's happening with the freight markets to check out, because I kind of, some of what I do to sound smart is just parrot what other people say, and I got a lot of smart people I listen to. And so I would look at, one was an article that was published like 2 days ago or so with Flexport's head of ocean freight strategy and pricing procurement. His name is Nereus Poskis. On Freight Waves. He did a great Q&A there, and I thought it was incredibly insightful. So people want to go deeper on what to expect from the ocean freight market, how to plan, definitely check that out. We'll do our best to keep being talking heads that can sound smart on stuff. But at the end of the day, wow, predicting the future is super hard. So I respect, as much as I might make fun of the economics profession for getting it wrong, I respect your courage and being willing to make some predictions, Phil.
Yeah, and we got some of them right, too. All right, thank you very much. Well, we obviously could have gone on for quite a while, lots of fun stuff to talk about, but we're out of time. We want to be respectful of all of you. That is the end of today's webinar. Thank you, Ryan, for a great conversation, and thank you to everyone out there for attending. We will email out the slides and the link to this recording tomorrow morning. There will also be a short feedback survey presented when you log off this call. Please take a moment, share your thoughts and your feedback with the team so we can continue to curate great content for you. So thanks again. Have a great day. Happy holidays and Happy New Year when it comes.
Bye-bye, everybody.